Yeah, I am here to give you another sounding amazing record of my market cycles of AMD. So whether you like it or not, it has been confirmed that patterns do repeat, and these cycles come in a different form, in a different shapes. Now, before we go into that, we want to first of all get the why this is also then why we want to get this from mouth of many market legends who are also the market makers, the hedge fund managers, institutional traders, investors who truly believe and have proven this methodology as effective so far. Then we're going to see that William Grant and others who truly believe in market cycles. I'm not trying to budge you with about. I'm just trying to tell you that whether you like it or not, if you see these patterns market, it can give you another edge. It can give you another edge in your trading. In your trading, like for example, we have this from William D. Gann. He said time is more important than price. When time is up, price will reverse. When time is up, price will reverse. That means time and price ratio or proportions work, so much. So when time and price meet at a particular junction, that means you expect a reversal. Like I've been showing you about uh, about our intraday market sessions of London opening and New York. So especially when you see these patterns fall at this periodic market sessions, expect a reversal. Expect a reversal. That is one. Then we have this from another market legend. I have to reserve this to you. Reserve this to you. Reserve this to you. I have this from. It's another word from Willie Digan. Yeah, its time is the most important factor in determining market movements. And by studying the past records of the averages or individual stocks, you will be able to prove yourself that history does repeat. And that by knowing the past, you can tell the future. I'm not trying to predict, I'm not trying to say, okay, well, this is how the future will be like, both whether you like it or not, market is by speculation. If the ability to be able to see pattern formation in the past will help you, to gauge to gauge the event that will manifest in the market subsequently. Then we have this another one from that we have this another one from the same thing is what this guy himself, the same thing he talks about. I've been telling you about this of Jesse Livermore. It's another popular market legend who has died some years ago, but this thing is still relevant in the market. Still relevant in the market. Jesse Livermore. Pattern repeats because human nature has not changed for thousands of years. It has not changed for thousands of years. Yeah. Then that's that for Then we look about there is a particular on market cycles. There is a particular book I just got about, and for 2 days I finished reading this book. It opened my eyes. That aided my my this on market cycles. Is by Edward Derwin, who is the president of the Foundation for the Study of Cycles in US, in conjunction with OG Madino. the title of the book is Cycles, the mysterious forces that trigger events. Go to internet. You can browse it on the internet. PDF drive.net. You can get this ebook and read it. You will see a lot of revelation from there. So most of the key points I got from this book are worth help me to, help me to, what the key point I got that oh no, this is not from the book. Yeah. Law of Mark Twain. Yeah, he quoted Mark Twain in the opening chapter that law of periodical repetitions. By the law of periodical repetition, everything which happened must happen again and again, and not correct, but at a regular period. That means each market turns happen at a particular regular period. Like you say of that New York and London open they are regular, and they are recursive in the future. It happens again and again and again. That's from Mark Twain. Then another one from this is another one from Paul Tudor Jones, that if there's a sudden range expansion in the market that has been trading narrowly, human nature is trying to fade that price move. When you get range expansion, the market is sending you a very loud and clear signal that the market is getting ready to move in the direction of that range. Yeah. So you will have a lot of this thing from the book. What the most important thing is that the patterns are predictable. He told me the patterns are predictable. They are predictable. Now because of our time, let's go straight to this point. Then I'm going to tell you about this. I'm going to show you in gold chapel. Gold market has been very, very, very consistent with this AMD daily market cycles. That if you understand this cycle, you'll be able to gauge your trading accordingly. Yeah, it accepts me. It accepts bearish market cycles. This is the range. We have impulse, comes as impulse, range, expansion. So that is the three major cycles we have in the market. We talk about range, talk about impulse. The first one is about the impulse. That's a move. Then the second is range. You got the range. Then the third is expansion in the direction of the impulse. Yeah, expansion. So these are the three circles that the market moves up and down. So that means whenever this expires, expect a new circle to form. This is the bearish market cycles impulse. That's a bearish impulse. The market will range. After the range, what do you expect? Market expands in the continuation, in the direction of the bearish impulse. Then if it happens to be the bullish market cycle, that means market moves up a rally, an impulse, then ranges, then expands upward in the direction of the impulse. So that means that is the pattern, and this pattern remains the same everywhere. Now we're going to talk much more little about cycle. What do you understand about cycle? Cycles are recurring patterns with predictable regularity. Cycles comes at a regular period. Now, characteristic of cycles. What make it more significant? First characteristic we say cycles. Cycles are regular patterns. They do repeat. You've heard it from the mouth of those market legends, just the Liverman, the rest of them. They do repeat now and then. They do repeat. Now, second, we have here, you see it in the chart. Second, we have here, you say cycles are rhythmic information. That means they are rhythmic. There is a formation of rhythm. They form in rhythms. Rhythm is from a Greek word meaning measured time. That is, cycles happen in such a fairly regular period of time. That is what we gather from this market, that it is rhythmic. That means if it happens at a particular shape, so you expect that shape to be information in subsequent price move. Yeah, it is rhythm. It's rhythmic. Though three, we say rhythmic cycles are almost universal in nature. They are universal in nature, irrespective of any market, irrespective of any instrument. What you see in good in form is what you see in every other market. Now we say for the number 4 characteristic, we say cycles are symmetrical in wavelengths. They are symmetrical. That means if this is the length of this impulse, it grow expansion is going to come in the same proportion of this thing, like William Gann say that time and price proportion are the same. Yeah. So, and as such, they are highly predictive. Finally, they are highly predictive, whether you like it or not. They are highly predictive. Now, this gives us a kind of clue that when you see this fact, and you know, I'll usually quote, I usually quote this Bible text, now and then. Yeah, usually quote it now and then. Okay, this is coming from the same Adam Smith, the money game. So you do have to know what time of market it is. Market goes in cycle, like all the other rhythms of life. The market goes in cycle. It goes in cycles. It goes in cycles, and these cycles are rhythmic. Rhythmic in nature. They are rhythmic in nature. So then we have a I have a kind of biblical text to point out on this thing. When you gather this from, when you get this far from many, the amount of many experts and witnesses, you know, it gives you a kind of confidence. It gives you a kind of mean that this thing does not happen as magic. It does not. There is a high predictability, and there's a high predictiveness of the formation. Yeah. In the book of 2 Corinthians, chapter 13, verse 1, it says, "This will be the third time I'm coming for you." You know, that's the Apostle Paul telling the people, the Corinthians, this will be the third time I'm coming to you. By the mouth of 2 or 3 witnesses, every word shall be established. By the mouth of 2 or 3 market legends, or 3 experts, or 3 market leaders, every word shall be established. Let me put it that way. Every word shall be established. Let's go back to that. So I'm just showing you for me to get the references why I so much believe in this. I've gathered in fact from different angles, from different mouths, from market experiences itself, then the ideology and the principle that support the predictability of this methodology called market cycles. Yeah. So if you watch, this is good. This is good. Take note of this. This thing I show you. This is good. Take note of this. You see this formation up and down especially in good market. You see right now, this is good. This is the present one. This was yesterday on Wednesday. Yesterday, you know, we talked about our Wednesday midweek reversal. This is Wednesday, right? Then we have this. What it is? This is impulse. This is impulse leg, and this is the range. Market starts ranging, you know, overnight, the Asian, you know, overnight. Then we have it like this, upward ranging. Then the overnight of a Thursday, which happens to be today, Thursday. We have what we have this. We have the expansion. can see the expansion. So that means if you measure the number of pips that is contained here, it will be nearly the same wavelength that we've shown you that almost about 184 pips, 184 pips, 184 pips there. Yeah. 193 pips. But we can see almost about nearly almost the same thing. Only the same thing. So the wavelength is actually the same. So you can see it's redeeming. You can see the redeem. You can see the redeem. This is Wednesday, right? Then this is going to be for. Let me change it to 1 hour. Prefer to do 1 hour. So that it to be. Yeah. So this is why gold is moving up right now. We'll show you because one news just came in, and at the edge of that news, you see the rally because the leg of that circle has been completed. Yeah, that circle has been completed. That's why the move upward. Then you can see this. You can see this. See the redeem. See the redeem zigzag. Expansion. This expansion. This expansion. This is impulse. Yeah. So this range, you can see the range here. This is the range, and this expansion. And if you watch carefully, that's the redeem behind the DC. Whenever the DC is going to last, the final leg, the expansion leg is going to end at a particular zone. I'm not supposed to read, but I'm just revealing this to you. If you are very smart, you'll be able to see it here. Yeah, it ends at a particular zone. Then we expect another DC here, which is this place. We expect another impulse. This is another impulse here. This is another impulse. Then we have a range. Then what's happening again? You have the end, which ends at this demand here. Demand. Then in between here we have the imbalance above this demand. So, and this is Wednesday. Right? And we have this zigzag again. Another zigzag. This is impulse, range, expansion. Impulse, range, expansion. Impulse, range, expansion. Can you see that? Impulse, range, and expansion. You can get that far. So the same thing happened here. See it here. So this one happens on this Wednesday or thereabouts. Yeah, this Friday. Yeah, Friday. So that leg ends on Friday with this into this that zone. And this is Thursday. This is Wednesday. You can imagine this leg ends on Wednesday midtime reversal. So with the conjunction with the convergence of those points, we'll be able to we'll tell you about the when you have two or more witnesses confirming a point. That means a word is established, a fact is established. This is another range here. See this? From here we have impulsive leg here. Then here we have a range. Then we have expansion. If you go backward, you see there's a particular place here where the, you can see this here. Yeah. So it's where it comes into that zone there. Yeah. So, and this is imbalance here. There is imbalance here that comes in contact with that BMS, then price move here. And because this is the end leg, the end of that expansion. And this is Friday, right? This should be Friday. Yeah, this Friday, Thursday, Wednesday. What happened here? The end of that range happens on Wednesday. What happens here? The end of that range happens on Wednesday. The end of this range happens on Wednesday. So Thursday, this is Wednesday. The end of this range happens on Wednesday. Then Wednesday continue the range. Those are the points you must do. And if you watch carefully, you see that this place has an imbalance. That's why this move, where the range starts coming down. There's at every turn, either from the impulse or the range or at the end of the reversal, there must be, that's your checklist. You must have a particular zone or a particular fact that must establish that that impulsive or range coming to end. You can see, imagine here, this is impulse, range, expansion. Impulse, range, expansion. Yeah, this is Wednesday. Yeah, impulse, the beginning of a range. It comes in contact with this, demand zone, right? Come in contact with this demand zone. Because this is Wednesday, right? This is Friday, Thursday, Wednesday, and you see market move in a range. So you expect what? You expect money to be what? Because it ends at this particular supply zone. Drop, base, drop, supply continuation zone. Then it comes down in the same wavelength of this impulse. This is the wavelength of this. This is the wavelength. Then the range starts happening on Wednesday. The wavelength. Then if you bring this forward, to expansion, here we have expansion here. You can see the reading. Then in between this here, what we do have, we have this range expansion. In between this impulse here, we have this impulse range expansion. We end at this imbalance. See that imbalance there? This imbalance. Imbalance, and because it's a strong imbalance because it comes to the BMS. Yeah, in between this range, what do you have here? We have this impulse, then range expansion. This is on Wednesday, right? Wednesday, then pull up another to supply. You will not be able to pass through here. You'll not be able to take more than this place because of what? Because you'll be taking note of this supply. Impulse, range, expansion. Impulse, range, expansion. But it could be somehow in the first place, it could be somehow difficult to predict in the front place, but it is like that, T 30th century. It is like that. You can have the formation in two times. Yeah, especially when you have, like, for example, this is coming from this. This is a range. I'm sorry, impulse. You have impulse here. You have a range. Then what do you have? Because this range happens where it happens here. This is imbalance here. There's imbalance here. So it's a coincidence with this as a confluence point. That's then we have expansion. So because this will be Wednesday or thereabouts. Okay, this is a Friday, Thursday, Wednesday. You see it? It's a range. So it comes to Friday. according to Friday, it ends on Friday. The leg of that range end on Friday with this supply zone. In between here, we have this impulse range expansion, impulse range expansion. On Wednesday, it happens to be this. The range starts on Wednesday, then Thursday it bursts into this supply zone and starts coming down. So that you'll be able to use it to predict how long, if you enter a trade, how long your trade can go, and you'll also be able to use it to exit a point and enter into a new DC with this combination. You can see here right now that how let me use 30 minutes for that. News came in today, news came in, and with this news, from US, this retail sales, core price retail sale it came out so negative. So it's a negative value to US dollar. So what do you expect? So it's a negative value to US dollar. So when US dollar comes down, euro moves higher. The same way gold will move up. You see the blast in gold, almost about how many at exactly 130, 1330 GMT, 130. See gold moving higher because of that news. See it because of where if you watch and if you go back, you see that this is a read. There's a reading here. This is an impulse. See the impulse here, the impulsive leg. Then we have the range. Then so news came in agreement with the cycle. So every day, this is you must develop a cycle. And because if you look back, you see that this place happens at a particular level of a key support, or it happens, it ends here. You can see it as it takes out that place. You see that this ends the expansive leg of that cycle. It ends the expansive leg, and you are going to use your AMD formula, which is just use your AMD formula, which is SH, as your entry pattern. It's the same thing you use here. This is a confirmation entry. You see it here? You can see it here. So if you see that there is a reversal here. So you just go to a lower time frame, like around 1 minute or thereabout, to see the pattern. You can see this, the move. So if this is too risky for you, you can try the second one, which is this. You can see this is AMD. This is your BMS. Then this is your imbalance. This imbalance and price coming to it. Price coming to the imbalance. You can imagine how many pips you must have made there. How many? Almost about 223 pips alone in that news. I imagine. See, so it retests to that imbalance will give you big impulse, big move. So right now I'm still going to make that another impulse there, positive, like this. We come to this, we are expecting it to this place, then it will move higher. Especially if we come in that impulse falling one of the Fibonacci ratio, we're expecting it around this place. This is impulse range. Then we'll cap another blast. And because if you go to a daily time frame, If you go to a daily time frame, I'm just showing you so many things that support your action. You must don't just so this is what this is a particular zone. Then this is a weak liquidity here, a weak liquidity here, weak liquidity. Then if you watch carefully too, you see that that is at the end of a lot wave 5 coming to an end. One, oh, sorry. That's not what I wanted to do. 1, 2, 3, 4, 5. So from next week or thereabouts, we expect price to move higher from here, then move again lower to this place, then start moving up. Yeah, but we want to see this another range, impulse range, and this, then we start another new impulse somehow. If we don't have, because I'm expecting this, if pressure, we may have a new DC down. Whichever price gives you, if you break below here, that means you're going to take more DC. Yeah. So if you start moving, that means it's going to fall a new wave. Yeah, a new wave. Seeing this like this coming up. So that is the distance for you. Yeah. God bless you.